Have you ever wondered what drives the wild roller coaster of the stock market? Or what makes those numbers flicker up and down on your stock app? Welcome to the world of stocks, where the language seems foreign until you start diving into it. If you've never ventured into the realm of investing or puzzled over the enigma of stocks, you're in for a ride. Let's unravel the mystery together. Starting at the very beginning, what exactly is a stock? I remember the first time I dipped my toes into the stock market. I was 21. I had no clue what I was doing and really just followed a friend of mine who urged me to buy into a company. That stock investment didn't go too well, and I ended up losing some money once I sold out of it. Lucky enough, I had that friend who was also learning at the time to keep things in perspective. I found books that guided me through those early steps of learning, explaining the intricacies of investing. But not everyone has the same experiences. How would you even begin to navigate this maze without a guiding hand? After all, it's not like they teach this stuff in school, right? Join us on this journey as we uncover the fundamentals of investing, beginning with the basic question: what even is a stock? So let's dive right in. To understand what a stock is, let's go back in time and do a little history lesson. The origins of the stock market started way back in the age of Christopher Columbus, when a group of enterprising Dutch merchants wanted to send huge ships over to the New World to start trading spices, silk, and all kinds of other foreign and exotic goods. This required lots of capital that no single merchant could come up with on their own. So groups of investors started coming together to pool their money and become co-owners in these trading companies. These ventures were called joint stock companies, and shareholders started buying and selling their stock with other shareholders and investors. And thus, the stock market was born. If this is making sense so far, let us know by giving this video a thumbs up. The idea was so successful that joint stock companies started popping up all over Europe. As the volume of shares and number of companies increased, it became critical to have some sort of organized marketplace to buy and sell these shares. So, stock traders started meeting up at a London coffee shop, which became the centralized marketplace to buy and sell shares. Eventually, they took over that coffee shop and changed its name to the stock exchange. So that's how the first stock exchange was born, the London Stock Exchange. Today, there are stock exchanges all over the world, with the NYSE, New York Stock Exchange, and the NASDAQ, National Association of Securities Dealers Automated Quotations, being two of the largest and most important exchanges. Great, that cuts it for our small history lesson. Now you know that a stock is a piece of ownership in a company, and its origins came from the need to pool money together in order to fund big business ventures. This concept of pooled ownership in business is what makes it possible to build huge companies like Apple, Walmart, Southwest Airlines, and Coca-Cola. It takes billions and billions of dollars to build a company like that, and most people don't have the money to do it on their own. Unless you're Elon Musk. Elon Musk started Tesla on his own, with $70 million of his personal money. But even Elon Musk eventually brought in outside investors in order to keep scaling the company. So on June 29, 2010, he did what's called an IPO, or initial public offering. An IPO is when a private company first starts offering its shares to the public. Before the IPO, the only way to buy shares in Tesla was to call up Elon Musk personally and discuss those details with him. But now, after the IPO, Tesla's shares now trade freely on a stock exchange. So anyone who has a brokerage account can buy stock and become a part owner in Tesla. So that's the difference between shares of private companies and shares of public companies. You generally can't buy shares of private companies because there's no centralized, standardized place to buy them. But anyone can buy shares of public companies easily and conveniently. So the stock market is where you can buy and sell shares of these public traded companies. Most companies start out as private companies, and when they get big enough, they can do an IPO and become publicly traded companies. Notice that we're using the word stock and shares interchangeably. They basically mean the same thing, except that shares are the units of measurement. So you would say, I own stock in Tesla. Or you could be more specific and say, I own 50 shares of Tesla stock. So now you know that a stock is a piece of ownership in a business, and you now know that the stock market is made up of shares of publicly traded companies. Now, let's talk about stock prices. This is what comes up when you Google Apple. You can see the stock price right here, and that the market cap is $2.99 trillion at the time of making this video. Market cap is the total market value of a company's outstanding shares. So for all the investors out there who own Apple stock, their shares collectively are worth $2.99 trillion at the current stock price of $192.53. So that means for $192.53, you can become a 0.000000002% owner in the company. Or if you're a big institutional investor and you bought 100 million shares of Apple, then you'd become a 0.02% owner in Apple. To own 0.02% of Apple means that you own 0.02% of everything the company owns. It also means you're entitled to 0.02% of the company's profits. So it's all proportional. So the stock price reflects whatever people want to pay at any given moment to own a slice of Apple. The stock price is very volatile. It moves a lot, all the time, 24/7, and movements in stock prices often have nothing to do with the actual earnings potential of the company. So we want you to keep that in mind. The stock price is very unpredictable in the short term, while the company's underlying value and earnings potential is much more stable and predictable. Let's quickly go back to the story of our Dutch merchants. Let's create this scenario. Their trading company is absolutely killing it, and they're making huge profits. Let's say they make $1 million in profits each year. There's 10 shareholders, which means the profits get split up 10 ways, putting $100,000 in each shareholder's pocket every year. If one of the shareholders offered to sell you his piece of the company for $100,000, would you do it? The answer is, of course. Since each shareholder gets $100,000 every year, if we buy his piece of the business for $100,000, we'll make back the purchase price in just 1 year. Now, what if he offered to sell it to you for $1 million? Then we'd have to think about it some more. For $1 million, it would take 10 years to make back the purchase price. And that's if the company is still in business for 10 years and nothing bad happens. The moral of the story is this: the price of a stock is driven by the company's profits. Stock prices go up and down because the market thinks profits will go up and down. Profitability is the foundation of what creates a stock price. This is how it works in the long term. But in the short term, sometimes stock prices have no connection to profits. For example, right before the dot-com bubble popped in 2000, there were internet companies with no realistic prospects for revenue, but they were trading at sky-high prices. This happens when market participants who lack knowledge get greedy, and this happens more often than you think. We want you to be very aware of this. Stock prices that have no connection to profits ultimately correct. It might take a while, and you might even get lucky and make a quick buck or two. But stock prices always come back to true value, which comes from a company's profitability. This goes both ways. If a company's stock price is too low relative to its profits, then the stock price will eventually go back up. Benjamin Graham, one of the greatest investors of our time, explained this concept in his book, The Intelligent Investor. He said that in the short run, the market is like a voting machine. So it's a popularity contest between the hot firms and the not so hot firms, and it's all depending on the opinions of the general public. But in the long run, the market is like a weighing machine. It's very precise, and it assesses the real substance of a company. So if there's just one thing you take away from this video, let it be this. What drives stock prices in the long run is the company's actual underlying business performance, and not the public's emotional opinions about the company in the short run. For more beginner-friendly info on stock investing, make sure you also check out some of the videos on this channel. And if you're new to the channel, hit that subscribe button for more great videos every week. Always remember, financial freedom starts with a playful mindset. Live life on your terms. Catch you in the next video. Cheers!